let me dwell upon this in some detail. First and foremost is the fact that our target is the headline inflation, where food inflation has a weight of about 46%. With this high share of food in the consumption basket, food inflation pressures cannot be ignored. Further, public at large understands inflation more in terms of food inflation than the other components of headline inflation. Therefore, we cannot and should not become complacent merely because core inflation has fallen considerably. Second, and equally important, is the reality that high food inflation adversely affects household inflation expectations, which have a significant impact on future trajectory of inflation. Household inflation expectations, after witnessing a moderating trend between May 2022 and September 2023, have edged up on the back of high food inflation since November 2023. Persistently high food inflation and unanchored inflation expectations, if they materialize, could lead to spillovers to core inflation through pickup in wages on cost of living considerations.
Persistently high food inflation and the risk and danger of a spillover into core inflation, that seems to have been the main guiding factor behind the Reserve Bank of India and the Monetary Policy Committee's decision today to continue to stand still on interest rates. The 9th time it has chosen to do so in sequence. Not much has changed in the Monetary Policy Committee deliberations and the statement that was made earlier today, of which you just heard RBI Governor Shaktikanta Das's key comment about food inflation. So what is the reading of the Monetary Policy Committee as far as the overall monetary stance and the situation on the ground is concerned? And to discuss that with me, I have Madan Sabnavis, Chief Economist of the Bank of Baroda, and also Rumki Majumdar, Economist at Deloitte India. Thank you very much for joining us. Madan, I am coming to you first. Not much seems to have changed, but the RBI seems to be pretty strident in its remarks as far as food inflation is concerned, and that's not new. How would you describe today's outcome of the MPC?
Siddharth, the way I look at it is that there have been two issues which have often been raised when we're talking of RBI keeping the repo rate at wherever it is. The first part is that does monetary policy actually affect food inflation or not? Now, we all know very well that by keeping interest rates high, I don't bring down the prices of vegetables. So I think that is what RBI has reiterated when they have spoken of this thing which you have shown before we began talking, that if food inflation is high, consumers are affected, inflationary expectations go up, it could be feeding into core inflation, and then it becomes generalized inflation. And I think the second point, which he actually started off, because I think whenever there's a contrarian view given within the committee as well as among economists and analysts, is that growth gets affected. So I think when he started off the speech, he actually had mentioned very clearly that growth is something which has been very steady. We're doing very well, probably on this path of 7.2% growth path, which really means that this entire argument given that by holding on to the repo rate at 6.5%, we would be impacting growth. That is something which the RBI has given a counter argument. So I think the messaging has been very clear to all the people who have taken a contrary view that we should be lowering the repo rate because growth will get affected, or that you cannot control food inflation by keeping the repo rate at 6.5%. I think that is what has been the message which has been sent on the part of monetary policy, besides the other things on banking which we could discuss.
Rumki, is this high dogma as far as inflation control is concerned, a dogma that has been written about and is the global consensus, but doesn't really matter when it comes to food inflation in India? Food inflation reacts to rains, it reacts to seasonality, it reacts to supply disruptions. How will keeping the cost of money high help us control persistently high food inflation? And Rumki, to add, if rates have been high for so long, why is food inflation still so high?
Thanks, Siddharth. It's a very difficult decision for RBI to keep policy rates high, because at one hand it is dealing with a supply side challenge which a policy rate cut actually cannot address. It actually can only impact the demand side of the economy, as Madhusudan has mentioned about it. But also the fact that food prices has been high, and it was rightly called out that 46% of a food basket is something which cannot be ignored. And given that 87% of the population, which is in tier 2, tier 3 cities, where the consumption of food is quite prominent in the consumption basket overall, prices do impact, and that's why they are probably trying to contain the demand side of the economy as well as expectations, both together, to keep the prices to be on check. But yes, to be honest, supply side is something which the government, RBI, cannot do by just checking the policy rates, and I think the government is doing its bit by addressing the supply chain issues. In the budget, the finance minister did mention about how to ensure that the inventory management and the supply of food perishables is something that can be taken care of.
Madan, is it time to change the basket? I am not asking this. The economic survey very clearly alluded to this, and I just can't get over the fact that there is dogma in this regard which perhaps doesn't work in the Indian context, Madan.
See, if we're talking in terms of changing the composition of the food basket of the CPI, I think we shouldn't be changing it just because we want to do it. Okay, let me bring two things on the table here. One is that, yes, we need to change the CPI composition because it's an old index based on 2011-12. So therefore, we need to bring it to something which is more up to date. The problem we have is that what is going to be the base year which we're going to choose? Okay, if I'm going to choose anything after pandemic, I think we will have this issue of the base being very high, being very low. So therefore, we'll have to take something back towards 2018-19. If I take it 2018-19, there will again be a group of people who will say that is 18-19 really contemporary, or are we still taking something in the midway through? Second point, Siddharth, I think if you actually look at what has been the average core inflation in India, because I think everybody was harping on this fact saying that the CPI is wrong because we have too much of emphasis on food products. Core inflation since 2011 has actually averaged around 5%, which means that the policy decision, even if I base it on an average core inflation for the last 10, 15 years, will not really be different from what we're talking of today. The reason is that core inflation is something which will be creeping upwards all the time because producers would always tend to need some kind of an incentive in order to produce, for which means that your prices will keep increasing. We have had time periods when inflation came down to very low levels of 3% because food inflation actually went into the negative territory. So I think we should be very, very cautious when we're talking of this entire concept of changing the base here. Let's not be in a hurry. We have to make sure we get the right base. Today, it's not possible to get the right base for a simple reason that COVID has distorted everything in terms of GDP, IIP, CPI, WPI. So I think it has to be done in a very, very careful manner so that because once we have a base, it's going to remain for the next 10 years or so.
Madan, fair point there. And I also, this is the last point that I want to take up on this ideological matter really, that if the government of the day, although they rolled it back, could even take a call to do away with the economically justified concept of indexation, then why not address this? But let's leave that aside. Overall, what does this policy do for maintaining India's growth, which is essential to create jobs, Madan?
See, as of now, I think it's been proved that by having your repo rate at 6.5%, it's not militating against growth. Because again, if I look at it historically, what has been the average repo rates starting from 2010, we'll see it's been in the region of 6.5%. Now, we feel that 6.5% is high. Rather, when I say we, I'm talking of industry. They feel that 6.5% is high, primarily on account of the fact that we were at 4% at one point of time. Now, 4% was a very unusual conditions where the RBI did everything to protect growth. That's why we came from 6.5% to 4%. That time, of course, we were less than 6% at the time when COVID struck, so we went to 4%. So what they've actually done is that they brought it back to the normal range. To my mind, 6 to 6.5 is the right kind of a range, which will actually sustain growth in the region of 7 to 8%. maybe not immediately, but we will get that 8% growth maybe in the next 3 to 4 years' time. So I don't think we are actually misaligned when it comes to linking your repo rate to growth. And I think that's one of the points which I think came up later on. I think it was in the press conference where they spoke of the neutral rate of growth. That is the real, the neutral rate of interest, which is basically your real interest rate. Today, when I'm talking of inflation in region of 5%, 6.5% repo, I think we are very well aligned to it. So if we're going to go anywhere down right now when inflation is still at 5%, then I think there will be a misalignment. So presently, I think there's a fair enough of equilibrium as far as interest rates are concerned in terms of balancing the trade-off which you have between growth and inflation. Growth is very much on path. So therefore, we could continue to work on seeing that inflation comes down, maybe not because of policy, but under your supply conditions improving before you can take any other action on interest rates.
Rumki, come in on that very same question to you, add to the debate.
To be honest, yes, I believe that there are quite a few factors that the RBI is considering while keeping the policy rate stance consistent. Because one, that of course, given that we have seen food inflation being high and core prices have been consistently coming down. But again, the fact that credit growth has been consistently been at around 15-16%, non-food especially. So far the high interest rates have not hurt the credit growth. So I agree with Madhusudan that it's so far being very supportive of growth. But another factor that RBI will have to consider is what the US Fed is doing, because they have to keep the interest rate differential so in order to attract capital into the country. And so far in the last 1 year, we have seen the FDI and capital flows being a little modest because of global uncertainties. So if they have to keep that interest differential high, the RBI may not have much of a room to cut policy rates going forward either. So I think the RBI is doing pretty good at keeping policy rates stable as long as the US Fed doesn't make a move.
Absolutely. And Madan, this is important from a broader markets perspective as well. The fact that something that the Japanese central bank does and sends global markets into a tailspin is far more important. And of course, Indian markets too have taken this in stride. This was completely expected. On the issue of deposit mobilization for banks, that question was also addressed in the press conference. What did you make of the governor's comments as far as bank deposits are concerned, Madan?
Siddharth, there's always been this debate about whether funds are moving from bank deposits to mutual funds. And there's this thing which, I don't have an answer to it, because people always say that if I'm putting money in a mutual fund, it goes from my deposit to the deposit of the mutual fund. Yeah. Mutual fund puts it into a corporate bond, it goes into a corporate account, but there are obviously leads and lags which are there. And I think what the RBI is acknowledging the fact that banks are definitely having a problem in terms of garnering resources. And that's one of the reasons why they're going in more for short-term liabilities, they're borrowing, or they're also raising these bulk deposits at higher cost. So I think there is a kind of a signaling given by the RBI saying that you need to be a bit more innovative, which means try and make sure that you come up with certain kind of innovative products through which you're able to actually garner resources from the households itself. So this has been a major problem which we're having. It's a kind of an anomaly we have in the system, because on a daily basis, we say there is surplus liquidity in the system. At the same time, if you look at the banks, they're actually trying to make sure to meet the credit demand. You're trying to raise high cost deposits, or maybe you're borrowing in the market in order to do it. So I think this is a kind of a flag which the RBI has, they've acknowledged, and they've also flagged it to banks, saying that since these are commercial decisions being taken by the banks, they need to do something about it. But the RBI, from the regulatory point of view, wants to make sure that it doesn't really create any kind of undue risk or any kind of mismatches in the assets and liabilities of banks. So I think that's what they're really highlighting out here.
Did you notice anything that was important from a point of view of the earlier concerns expressed by the central bank with regard to the rise of unsecured loans, Madan?
Yeah, definitely. I think what they have said is that it's at a micro level. See, earlier it was a case of saying it was a macro issue where it felt that generally banks were overextending finance to unsecured loans, which means there was systemic risk which was building up. But today, I think that he has again reiterated that he has emphasized that there are certain entities, not necessarily in the banking system, but more in the financial system. So obviously, their supervision, the supervisory processes have revealed that there are certain entities in the financial system who are probably still lending a lot on this particular account, unsecured loans, credit cards, and so on. So that's something which they have obviously spoken to the concerned entities to sort of tone it down. But they're also raising this, saying that from the point of view of financial stability of the system, it's necessary that there are checks which are placed internally by the banking system as well as the NBFCs to ensure that they don't overextend credit on the spot.
Rumki, let's look ahead. Now, what does it seem to be the case as far as the interest rate trajectory in India is concerned? Over the past several months, I have noticed that experts like you have kept pushing the can, so to say, and now in the last discussion we had on this matter, it was the last quarter or the first quarter of the next calendar year. Are you maintaining that, or has it been pushed even beyond?
The growth outlook?
As far as a possibility of an interest rate cut is concerned, Rumki.
Interest rate cut. Okay, sorry. We expect the RBI to keep the policy rate stable for longer, because as RBI called out this time that they expect the inflation to be on the higher side given the intermittence in the rains that we are seeing. Of course, so far the Kharif sowing has been good, so maybe over the next 1 or 2 quarters things might subside, but still inflation be high. And again, will be very contingent on how US Fed moves. And we have been hearing US Fed policy rate cuts from since the last year, but it has not moved its policy rates yet. So both those factors will be considered before RBI decides to make a move, and we believe it will be a difficult one to take a call on cuts, at least in the next few months.
Madan, what's your assessment of the same question? When is there a possibility of a rate cut in India?
Okay, there are 2 points I'd like to make here. One is to what I would also like to address what Rumki has mentioned about Federal Reserve. I think, in the last few policies, the RBI has always maintained that whatever decisions are taken based on domestic considerations, domestic inflation. So while they do look at what other central banks are doing, but definitely they cannot ignore what our central banks are doing. But primarily, they'll be driven by that inflation number of 5.1% or whatever trajectory it takes on. But I think what is significant in this particular policy, in the statement which the RBI read out, he's mentioned saying that there are some central banks who have raised the rates, some of them who have lowered them or could be lowering them, which again gives a very clear indication to the markets, saying that don't keep betting on the fact that merely because Federal Reserve could be cutting rates at some point of time, we're going to follow suit. Why are we choosing Federal Reserve? Why not we choose Bank of Japan? Because what Bank of Japan did last week was something which actually had a more serious effect on the market compared to the Federal Reserve. So I think the RBI is actually trying to tell the markets that, look, don't keep always thinking that because Federal Reserve or the ECB or the Bank of England is doing something, we're also going to do the same thing. Now, that's coming more specifically to the question which you've asked for in terms of when could the RBI be taking action on interest rates. I think when they have said that they are very comfortable with the fact that growth is very much on target, it means that growth will continue on that 7.2% path. They will be actually monitoring how the inflation number pans out. Now, we had 3.8% inflation for the first quarter, for the second quarter, which has been revised to 4.4%, which means that even till September, we are going to talk of inflation of 4.4%. For the third quarter, they've given an estimate of 4.7%. Which means that in October, it looks very unlikely that there could be a serious discussion on rate cut based on inflation movement. Of course, if the inflation numbers turn out to be more hospitable, they come down for some reason, then of course it could be October. But to my mind, I think in October, it may not really take place. And therefore, I think December would be the earliest point of time when the RBI could take a more concerted view on whether or not there should be any kind of a rate action. Now, this said, we should remember that in his speech, La Nina came up twice. At one hand, you have said that La Nina coming in the second half of the year could destroy agricultural crops. And later on, it has been mentioned that La Nina is positive for the Rabi crop and for the Kharif crop. So we're not quite sure whether La Nina is going to destroy crops or whether it's going to aid the Rabi production. So keeping this in mind, I think that's another kind of a threat which is there, that in October, if there is excess rainfall, it could be useful for Rabi, but it could also have an impact on output of rice and pulses in particular, besides vegetables. Tomato problem normally comes in the month of October, November. So that is something which could also take place. So therefore, I think on a conservative basis, we could say that December could be the earliest point of time when a rate cut could be considered, provided everything is normal on Kharif and inflation also comes within the range of 4.5%.
So viewers, there is very little action when it comes to policy rates in today's meeting, and that has been the case for 9 times in a row. But it seems that as far as UPI is concerned, there is never a dull moment. Dilip Asbe of the National Payments Corporation of India has pointed out 2 important announcements. I just want to mention them before I go to Rumki. Delegated payments on UPI, increasing the UPI limits to 5 lakh for tax payments and continuous clearing of checks. Rumki, increasingly the non-rate part of the MPC's deliberations is what seems to give comfort for users. That is where all the action seems to be happening. What does continuous clearing of checks mean for banking users in India? Would you have a comment on that, Rumki?
So at least the government is trying to ensure the money supply is good and there is credit availability despite the tighter monetary policy stance that the RBI has taken. So that probably is helping ensuring that the credit growth that we have seen despite the higher policy rates to be very consistent. And I think that will help keep the momentum of the growth as well, because right now a lot of growth in MSMEs and small scale industries are contingent on growth of credit that is available to them. So I think this will help in boosting the overall outlook for growth for these sectors.
Madan, one final topic to discuss with you, and this is to do with the RBI's worries. We touched upon it briefly, but just for the sake of our viewers, the comments about banks continuing to find it difficult to raise deposits and the shift to other non-financial investments, physical investments. What do you make of the governor's comments in this regard?
So I think the governor is essentially trying to urge or nudge banks to use more innovative ways of raising resources, because they're going to have a very competitive field going ahead, which has already started. Because if you see with inflation being high, bank deposit rates are more or less maybe 6.5%, 7%, 7.5%. You're not really getting that kind of a real return, especially if you want to increase consumption. So what are people doing? They're looking towards the markets, either directly into equities or in mutual funds. So if you look at the AUM on the mutual funds, it's got a phenomenal rise last year, 15 lakh crores or so. And even in the first 3 months, it's been around 6.5 lakh crores. So definitely there is a case of funds moving out from the banking system, though finally they would be coming back into the banks, but definitely financial savings of households have definitely looking for fresher pastures. So the message from the RBI is that as credit continues to grow at 14-15%, which is what will be required to keep the economy growing at a rate of 7.5% in the next couple of years, it would be imperative for the banks to make sure that they're able to ensure that there is a flow of funds which come through the deposit routes, because nearly 70% of the liabilities of banks are in deposits. So they will have to really concentrate on these deposits and also make sure that the costs are kept down, because today when we're saying that the banks are doing very well and they don't require any further additional capital to be raised in the market because you're making good enough profits which are being used to push up your tier 1 capital. It will be necessary to also ensure that you're able to preserve your net interest margins, which means that you need to keep your costs also down. So that is entirely something which can be taken as an implication of what the RBI has said in terms of garnering of deposits.
Absolutely, and that comment, viewers, is significant from the governor, because in the run-up to the budget, influential people within the banking community, including the public sector banking community, had spoken about the difficulties to raise deposits, and there were expectations that the budget would try and address them. That didn't happen, and the RBI hasn't done it. So the broader point is that as far as your fixed deposits are concerned and your investment strategy, that field remains open without regulatory or fiscal policy intervention. Madan Sabnavis, Rumki Majumdar, thank you very much for your time in decoding what the RBI has done today. We'll continue our coverage of the markets as we come back after a short break. Thank you very much. See you soon.
This is a bit of a homecoming for me, as some of you may know. When I was in high school, my family moved back from the U.S.